Hello, and welcome to another episode of Enter the Boardroom with Newroll, the business podcast that brings the boardroom to you. I'm your host, Oliver Cummings, CEO of Newroll, the board search specialist and market leader, bringing science to the art of board hiring. Before we get into the interview, I want to let you know about the Newroll board community. One of my favourite elements is the Newroll Mastermind, a safe haven for board members to discuss challenges and opportunities with peers. As an observer, I've been struck by how valuable it is to just listen to these discussions, which often make me more aware of my own blind spots as a board member. It was this realisation that catalysed the launch of the Newroll Board Community Discussion Forum, where members can seek advice and share experiences on pressing challenges and opportunities openly or anonymously. I always loved the idea of being able to tap into the hive mind of the Newroll board community and get its best thinking, of tapping into its network to open stubbornly closed doors. Well, now you can. Recent popular discussions include how to reconcile CEO board differences about a chair candidate. How do I manage conflicts of interest as I go plural? What can I do to get our new CEO up and running as quickly as possible? And how to be a good investor director. If you want to know what's top of mind for your board colleagues, or get help with a challenge you're wrestling with, or open a door for you or one of your boards at the click of a button, you can try the community for free for 30 days. As well as discussion threads, you'll benefit from smart online networking, one-to-one career guidance with our headhunters, third-party board roles, mastermind groups, and Q&As with senior board members. Head to community.newroll.com to find out more. Today's guest, Alex Denny, is a non-executive director and chair of the Nominations Committee at the Association of Investment Companies and trustee at the Nautical Archaeology Society. Until recently, he was a managing director at Pantheon Ventures, an asset manager, and he was formerly head of investment trusts at Fidelity International, another asset manager, where he spent almost 20 years. Alex, could you just start by giving us an overview of the UK investment trust sector and how it fits into the global picture for those listening to this who are thinking about taking on board roles and considering the investment trust spaces where they might look?
Maybe I'll start with a bit of historical context without being too navel-gazing. But investment companies, investment trusts have been around for a pretty long time, since the late 19th century, which makes them about the same age actually as the earliest pension funds in the UK. And probably around the world, to be honest. The first one, now F&C, was originally Foreign and Colonial Investment Trusts, which launched way back in 1868. The reason I raise it from the historical point of view is originally they were there for UK individual investors to get a diversified exposure to overseas markets. As time has gone on, they've expanded to do quite a lot more than that. So you've got investment companies that will focus just on UK markets, on international markets broadly, individual countries, as well as a whole load of more specialist assets. So you've got things just focused on healthcare or renewable energy, energy storage, space, all sorts of things, because investment companies are very useful ways of channeling capital into particular sectors. And it's really to do with the liquidity that you need to make investments into particular assets versus the liquidity you can get as an investor. And I guess in that context, from a UK perspective, where you've got the government focused on things like productive finance and driving investment into smaller companies, newer companies, private equity, infrastructure projects, etc. Investment companies have proved to be great vehicles for raising capital for investment into those types of strategies. I should put that in the context that if you look at infrastructure, private equity, sectors like that, they're not necessarily only investing in the UK. Many of them are investing internationally. So we have to put it both in the global context and the local one. I think, again, investment trusts are UK structures, but they're also a pretty large part of the UK listed market overall, the UK corporate world. So they're a significant part of the FTSE 250, the FTSE All Share. There's a few in the FTSE 100. And they're a great way of kind of democratizing access to asset classes because they're listed shares and anybody with an ISA can buy listed shares. But it would be wrong to think of investment trusts as solely retail vehicles. They can be used by large institutions to gain access to things. They are invested in by pension funds, particularly in the DB world, a lot of use by insurance companies, etc. And they are a great way of getting access to different asset classes for multi-asset investors in other fund types. And you also asked, why would people be interested in board roles with them? And I think, frankly, they're just really interesting. And for all of those reasons, they've got this interesting kind of hybrid nature of fund and corporate. They are PLCs, and if people want to get PLC experience, they're a great way of getting access in. But they are also from a board perspective, somewhat simpler, I think it's fair to say, than some operating companies where you might have huge numbers of staff, employees, and those kind of responsibilities. Generally, not always, but generally investment trusts have got outsourced management arrangements. So the board is entirely non-executive and they're appointing someone else to manage it for them. So it's a fairly pure oversight governance type role that you'd be playing on the board of an investment company.
Your various roles, you must have seen quite a range of investment trust boards, going from the good to the bad and the ugly. Could you flesh out what those have looked like to you and what have been some of the hallmarks of those best boards and what have been the hallmarks of the worst?
Unfortunately, I don't think I've ever been involved with too many boards that I would consider to be outright bad, but I've certainly been involved with some boards that were pretty old-fashioned. And so one of the things that's changed in my time working with investment trusts, which goes back probably until about 2012. Back in 2012, it was pretty common, for example, to have non-independent directors on boards. That management groups would put individuals onto boards to help influence things, I suppose, from within the board structure. That's gone out of the window. And I think rightly it wouldn't be appropriate in today's environment to have people in those positions. There's also been a change of board tenures. So there's far more focus on the 9-year rule and people actually rotating off boards after that period, because there were a number of individuals who, while I think were very fine directors in their own right, had been on boards for sort of 17 or 18 years. And it had become very much a sort of, this is the way that we've always done it attitude. It was potentially stifling of innovation. And these days, it's far more likely that boards will be sitting down and doing things like skills matrices and working out what skills gaps they have, as well as, do we need to have someone who's younger or from a different educational background or a different professional background? A lot more focus on ethnicity, etc. these days, but also nationality. If you're investing in Asia, should you have someone who is from Asia on the board? Is it helpful to have that? And it's questions like that simply didn't really come up before. So I think that while the journey had already begun by the time I was involved in investment trust boards kind of 10 or 15 years ago, it's definitely carried on down the route of no longer being jobs for the boys. It wasn't 5 people who've always known each other on a board together who are going to be there for 20 years. It's much more sort of professional these days. And I think as well, reflecting on that, it's right that it's professional because the expectations of these boards have grown so much higher. That's both from a kind of regulatory perspective, audit perspective, and what are they required in terms of governance, but also shareholders genuinely expect boards to have some power, influence and teeth these days and to be willing to make difficult decisions.
There are still a number of funds that are synonymous with the manager. And I suppose the Woodford Low Up be one example where I wonder how many board members are really brave enough to make a split of that sort where get rid of a manager with which their fund is synonymous.
I think Woodford, the very name raises the question, doesn't it? Because although the firm was called Woodford Investment, clearly it was his name. And if you are going to be involved with an investment trust where the individual portfolio manager's name is on the name of the company, then I think it is actually synonymous, isn't it? It's the very definition of the word. And that probably causes some difficulties. Now, I was lucky enough, for example, at my time at Fidelity and indeed at Pantheon to never be involved in losing the management contract of an investment trust I was involved with. I was, however, involved in winning one. So what used to be Genesis Emerging Markets became Fidelity Emerging Markets while I was there. In the M&A space, there's a lot of mergers between big companies going on at the moment. There's mergers between Henderson Trust, JP Morgan Trust, Aberdeen Trust. Aberdeen's going to Fidelity. And I think boards are happy to make moves from big asset managers when it's the right thing to do. And I feel that there is more pressure on them from shareholders to take action now. The Woodford example is a useful case in point in the sense that the investment trust still exists and has had several changes of managers since then, actually, and it's changed name 2 or 3 times since then, but the actual kind of core existence of the company and its portfolio is still going on. Whereas the open-ended fund, where it's much harder to sort of separate the manager from the kind of the contractual side of things and the influence of the ACD and that side of it was a lot more complicated. So I think Woodford can be held up as an example of good governance by investment trusts in the end. And I think what people have learned is that they should potentially be willing to act a bit sooner. I would also say that we shouldn't be complacent in the investment trust space. The fact that Woodford Patient Capital carried on existing and Woodford Equity Income didn't doesn't mean that there aren't examples of poor governance within the investment trust space. And there's been a few. There's an FCA investigation, I think, that's been announced into Home REIT recently. And I won't go into specific examples, but we shouldn't get lazy and assume that everything is okay in the sector, because we've seen instances where good governance has shone through in the past. But it does show that boards have got power and they should be willing to use it. I also don't think it would be right, and probably shareholders would be pretty panicked and distressed if it was the case that every time something was going a little bit off in an investment trust, that what would happen is that the management group or the individual manager would be fired and it would go and do something completely different. We need to have a long-term cross-cycle view, and we ride the storm sometimes, take the rough with the smooth. But the ability of boards to enact change has to be used as a bit of a stick to make sure that things are being run in the right way by those managers in the meantime.
In your experience, have you seen that at play where boards have used that, and how did they use that?
Absolutely, I have seen that. And I think, again, it's probably a bit different between some of the larger management groups and smaller ones, because the larger management groups have arguably got more levers to pull. If you're at JP Morgan, Henderson, Schroders, Aberdeen, Fidelity, somewhere like that, and you're not convinced that the specific implementation of the investment management process is working the way that you would want it to. The portfolio returns aren't great. You may well have other options in-house, which are far less nuclear, shall we say, incendiary than let's fire the manager, transfer the portfolio to a completely different organization, which is very disruptive and potentially quite costly. It might be possible to introduce new managers from within the same group, in which case you get all of the continuity of analyst coverage, and there's no problems with how do you handle the confidentiality of IP from one big management group to another. In smaller groups, that might be harder. And I think in some of the smaller groups or smaller management firms and self-management trusts, you might end up with a greater association with an individual person. And that's where it can be harder. The other thing I think that's important for boards to take forward in terms of their engagement with asset managers generally is to not be too reliant on that one individual person. There is this question, the portfolio manager or investment manager in investment trust is probably the closest thing that you have in that space to their CEO. And the CEO kind of driving the investment side of the business forward is clearly a hugely important role. But are they actually the best person to talk to about the kind of risk and compliance structures, the marketing of it, the IR side? And is there someone more akin to a COO? At Fidelity, we tended to view that as the head of investment trust role, but there are other similar positions elsewhere. And I think it becomes much easier to have these conversations about where things are going wrong. If you can talk to the portfolio manager, if you need to, about something's going wrong on the operational side, because you find it slightly more comfortable than going straight to the horse's mouth, or you could talk to the operational side of the business if you've got concerns around the investment side. But ideally, you can be holding each individual to account and you can make changes where necessary without needing to upset the whole apple cart. And sometimes, of course, it's the right thing to do, to upset the whole apple cart. One of the great things about investment trusts is that they do actually wind up or change manager or have substantial returns of capital. And you don't get the kind of zombie funds or ghost funds. People often talk about Morningstar data being riddled with survivorship bias, but investment trusts themselves are riddled with survivorship bias. Bad ones get taken out and good ones carry on.
You talked there about the not being too dependent on a single person. How much reliance is there on that star talent, and how big a risk is that for investment trust board members to consider?
I do think that people now want to understand the strength and depth of teams, and the kind of key man risk is probably front and center of lots and lots of investment trust risk registers. So it's very worth considering what happens in the kind of the worst case scenario is something just untoward happens to the division, isn't it? Kind of by the proverbial bus, and what's the plan after that? There's huge amounts of kind of reputational association if you've got individual managers who are very influential. Now, that's not to say though that there aren't some fantastic individual managers on whom it is right to put a lot of faith. So I don't want to upset the business models of those trusts, but you have to make sure that there's the right kind of governance risk framework around that. Do you know what happens if? And also, it's vitally important for the board, the audit committee of the board, and kind of other advisors to be able to robustly challenge those managers on their activities. Because the absolute worst scenario, I hasten to say, being kind of a la Woodford, is that you discover that something was going on that actually could it have been identified sooner? Was the challenge robust enough?
And so if you have got a star manager on the board that you sit on, what are the ways that you can mitigate that as a board?
I think absolutely it's having the backup and the building the team. So it's become increasingly common investment management groups to add sort of co-portfolio managers or named other portfolio managers on trusts. And it's true across the asset management world in general. The important parts of that to consider are, is that individual meaningfully actually contributing, and do they have their own influence, and are they able to robustly challenge? And it's a bit like just having four eyes checks on things. In the vast majority of cases, you've got these great investment managers and they are doing their job to the best of their ability, and they're doing it in absolutely good faith. But having someone else who's able to look and see what's going on and spot whether something's untoward going on in real time, I think is very helpful. And the kind of the whistleblowing policies that get put in place by investment management groups are very important. And one of the things that boards should be doing is checking that those are all robust and that they understand them. Generally, I think that the addition of a co-manager should be complementary. It doesn't take away from the ability of your kind of high-profile lead manager to add value. And also, lots and lots of boards these days, and indeed investors, want to have better access to the investment analysts and the kind of the slightly more junior investors within an organization, and have direct access. If you're having a conversation with your portfolio manager, why did you buy this particular equity, or why did you buy this particular infrastructure project? And they can say, I was speaking to the analyst. Well, why not have a conversation with the analyst directly? They can come in, present the case, the board can raise challenges, etc. So just getting better access to each layer of the investment process is very important.
And where do you see the best boards drawing that line between the non-executive role and ensuring that the organization is well run, and second guessing the investment manager?
The reason why you might want to interrogate an individual investment is so that you've understood the process by which the manager chose to make it, rather than to say, I don't agree that you should have made that investment at all. Reasons why a board might have, and again, the frequency of this happening is pretty small, but might have for saying an investment shouldn't have been made, would be because it actually doesn't fit the investment policy. It's not in line with what shareholders have been led to expect. Let's say you're focusing on a portfolio of high yielding, relatively low risk assets. If the board became concerned that investments were being made that were higher risk pursuing that yield, an individual case, I think good portfolio construction and your kind of portfolio theory would probably dictate that you've got some riskier assets and lower risk assets, and a different range of yields from that. But if you became concerned that increasingly the investment manager was having a sort of stylistic shift into higher risk investments that didn't fit with the investment policy, that's the point at which I think a board should be challenging more robustly individual investments. But it's the collective view, rather than why did you buy one supermarket over another supermarket in an equities portfolio. That's not really the kind of engagement I would necessarily expect to see a board make. And I also think it's, again, one of the reasons why it's helpful to have a kind of diversity of thinking in boards, because if you have boards which are entirely made up of investment professionals and investment managers, they have the habit of focusing very granularly on the individual investments. Whereas if you have people who've got more of a sort of governance background, or indeed more of a communications background, they're more interested in, does this make sense in the context of what we have said to our shareholders that we're going to do?
What do you see the best investment trust boards doing around strategy? I'm sometimes surprised that investment trust strategies are not as clear on why they will win in a competitive field as I think they might be. Often they'll say, we're doing X, okay, which is a product, and maybe there's a market out there that wants that product, but it doesn't strike me as a strategy. How do you think about that, and what do you see?
The best boards I've been involved with have had regular reviews of the strategy. So it's, board 101, isn't it? So you should have clear objectives and a clear investment mandate. But those clear objectives in the investment mandate aren't necessarily exactly the same thing. An investment trust has to have an investment policy. It has to have an investment objective, be that aim to achieve superior investment returns from investments in the FTSE 100, for example, selection of stocks in the FTSE 100. That's an investment objective. It doesn't get very to the detail of why or who it's for. You should have your investment policy or investment objectives, but you should also be asking yourself, are we doing this for mass retail? Are we doing it for institutional investors? What does your shareholder audience look like? And you need to put in the right metrics around that. If you're expecting to build a portfolio that you think is going to be really attractive to retail investors, how often do you stop and think, did we attract the retail investors that we expected? Or have we become suddenly targets for institutional activists who are buying us on a deep discount? And what should you be doing about that? I think as part of the strategizing, you need to be considering what feedback you're getting from your stakeholders and having a conversation over both the medium and the long term. We shouldn't be too short-termist about this. But do we still believe that we're delivering against those objectives over the medium to long term? And if not, is it because your objectives themselves need to be changed? Does your investment method need to be changed? Or is it something else that you're doing? Is it poor communication, poor marketing strategy? Just the last thing on that, in terms of just A, putting together a strategy and then B, delivering on it, is making sure that you are actually engaging with stakeholders and taking them on the journey, because shareholders in particular don't like to have things done to them. So you might decide actually this investment policy investing entirely in, I don't know, there isn't one, so I'll choose this, an investment policy investing in Jamaica. You could decide to go to Jamaica and Barbados or the rest of the West Indies, or you could decide that actually the West Indies wasn't right and I'm going to invest just in Korea. But is that just too much of a change and too far away from what you started with? And probably shareholders would turn around and say, no, that's not what I bought. It's not in line with what I was after. So give me my money back.
So that makes sense to me, that they should be clear about their objectives, where they're headed. But what about the why will we win, or in sort of Buffett language, the moat? What are the moats that investment trust board members should be giving thought to as they think about their strategy?
Yeah, I think there definitely are some moats, and also an understanding of what the competitive environment looks like is important. But at the moment, there aren't very many IPOs going on. There's a lot of new investment trusts coming to market, and one might ask the question, why is that? Is it because investment trusts are no good? Now, we know that investment trusts are trading at a discount, and the fact that they are trading at a discount makes it hard for new participants to come in any sector. Because there's always this question, why would I buy this real estate trust at par if I can go and buy an existing one? Or why would I buy a new US equity trust? The fact that they trade at a discount is probably a reflection of kind of liquidity of individual investment trust shares. And particularly at the moment, there is a supply and demand imbalance. But it doesn't mean that investment trusts in those sectors aren't doing a good job and that people don't still want them. If I want to launch a new European equities trust, of which there are quite a few and some pretty big ones, would I be doing anything that is particularly different to the other European equities trusts? And is it something that people want? Because I need to be able to prove that it's justifiable, that it's in a closed-end structure, that it's in a listed structure, that I'm making the best use of that structure, and that I am doing it better than the competition or sufficiently differently from the competition. If you can't do that from a new entrant, then the existing participants who've got scale, liquidity, hundreds of £millions of portfolios, long track records, established in investment processes, and frankly, probably investors have got used to the fact that they're trading at a 10% discount. They have a great competitive moat. They've got incumbent advantage, haven't they? And so what you want to do is not start changing what you're doing simply because the sector is trading at a discount. Probably your shareholders are quite comfortable with the level of discount that you're trading at. And what you want to do is stick to your knitting and do it better. Now, that's not to say that no investment trust should ever be making a change. They absolutely should be. What is their position against the competitors? Why will we win? People should be asking themselves each time, are we doing something different? Are we doing something better? And genuinely, I think one of the times where boards should start thinking the existential question about should we be winding up or merging in is if you haven't got scale, if you haven't got the performance track record, you haven't got the differentiation, surely it would be better to at least consider merging in with something that is bigger and has got the scale, etc. And investment trust board directors should be fairly selfless, I think, in how they consider these things. If it is the best outcome for shareholders and they were to end up merging in with another company, of which there's been quite a lot of consolidation going on recently, then I think much though they might put themselves out of their directorship job with that particular company, they're very likely to be rewarded by the marketplace of investment trusts in the long term by getting another board position, because they've shown that they actually know what they're doing and they've got the M&A experience from doing it, and they've shown that they've acted in the best interest of shareholders. So there will be times when you can't answer the why will we win question. And in other instances in the private equity space, for example, discounts have become really quite significantly entrenched. I know at Pantheon, with the Pantheon International Board, there was this question of, is the company still doing what it set out to do? One of the big challenges in the alt space at the moment, because discounts have widened out, is that there's been a breakdown in the correlation of share price returns with underlying NAV returns, because discounts just got so much wider. The share price performance has been significantly worse. Why do people buy alternative assets? It's normally because they want either outsized returns in sort of private equity space, or it's because they want better risk-adjusted returns and maybe a source of income in the infrastructure space. Recently, you've got to question whether either of those things have been true. So boards have taken pause and thought, what is it we should be doing about it? And there's been quite sizable buyback programs put in place, in some cases quite systematic ones. There is much more talk about mergers and corporate activity and wind-ups, etc. And so I think clearly, and maybe it comes almost as a sort of a tactical response to a challenge to the strategy that was set out. But boards are acting, but the willingness to act is vitally important, because in the absence of that, then the sector won't sort itself out. These discounts will persist. But if in 2 years' time those issues have been resolved, I think people will rightly look back and think that, okay, it was a cyclical problem rather than a secular one.
You talked about discounts a bit now, and I imagine if someone listening to this sits on an investment trust board, chances are their board will currently be trading at a discount at the moment. What are the best boards you're seeing doing about that? If that person listening now is saying, Alex, what should I have made sure that we've considered as a board in order to address that discount?
I'm going to try, in answer to this question, to not be too downbeat about a couple of things, because there are, I think, some fairly persistent problems with the investment trust sector at the moment, which are extraneous. And they're all tangentially interlinked. The first is that the UK stock market as a whole has seen a really significant decline. There's kind of 25% fewer listed companies in the UK than there were 10 years ago, and 40% fewer listed companies than there were in 2008. And in fact, investment trusts in that time have not seen anything like such a decline. But again, investment trusts have become an increasing proportion of the UK listed market. Now, that leads to a few things. They've become quite high beta to the market. This is the point I was making earlier. The uncorrelated alternative assets that are sitting with investment trusts in their shares have now become pretty correlated with UK markets, because they're such a big part of it. And that is a problem. And it's difficult for an individual investment trust board to sort of do anything that's going to improve the performance of the UK stock market as a whole. But we do need to be engaging on certain policy questions. And there's a lot of discussion at the moment around things like stamp duty. It's unfortunate that you pay stamp duty on a UK listed share, but you don't on a US one. So we should be trying to address that, and we should be engaging with policymakers around it. I know that lots of management groups do, but boards can too. Also, there's been a lot of challenges around the costs and charges disclosure regime. Our investment trusts are kind of unfairly made to look more expensive. There was a lot of issues from kind of capital adequacy rules, making it harder for brokers to put risk capital to work in investment companies. And again, that actually is partly being resolved. The costs and charges work that is ongoing, but I'm hopeful that a couple of those bits will be overcome. More kind of day to day, what can boards do about it? I think we can improve the communication around investment trusts. It's a bit of a kind of uphill struggle, and there's a part of me that thinks maybe it will never come to fruition. But in Europe, for example, people just don't understand investment trusts. So we don't get a lot of European capital flowing into UK investment trusts. If nothing else, we should be banging the drum saying, look, these are great assets and they're pretty cheap. So from an economic sense, we could probably attract more international investment from outside the Anglophone, Anglo-Saxon sphere, because the US, they will buy investment trusts. Even Australia, New Zealand, South Africa, they will buy investment trusts. But in France, no. We can't possibly cross the channel and buy an investment trust. And that's the kind of thing that we can do something about. And then the other thing is just now is the time to not be quiet. It's easy to get a bit downhearted and downbeat about the fact that investment trusts are trading at a wider discount than they have for a long time. And people start thinking, I spent all this money on marketing and I didn't see kind of an improvement in share equity, so therefore should I not bother? But actually, those that communicate well through the difficult times will come out in a much stronger position than those who simply don't. And I think now is the time to really focus on that messaging. The why will we win? Ask yourself that as a strategy, but also how do we communicate why will we win? And how do we reach the right audiences with that messaging? And double down on the effort, I think. That the best things that you can do as a board are to do the things that you should be doing anyway and doing them better. And that, I think, is the challenge that we all need to sort of face up to at the moment.
Alex, talk me through your own board journey. You've taken on various non-executive roles alongside your executive career. Really interested to hear how you've gone about that.
I started... My first board was as a pension trustee of the Phil UK pension plan. I somewhat grandly get to claim I've got Anthony Bolton's old job because he was the trustee I immediately replaced. I really enjoyed that, and I took it on because I partly wanted to see what life was like on the other side of the table. That was my selfish reason. But also I was a member of the Phil UK pension plan, of which I became a trustee. And I felt at the time there was a lot going on in the pension space that was very relevant to me and that I could help sort of add some colour to. So, for example, there were changes to the annual and lifetime allowance, which impacted people of my generation very differently to the existing trustee board, who generally had kind of protections in place, etc., or had a far greater certainty of what their likely kind of final asset valuations were going to be. We also had a combination of DB and DC assets, and I was entirely in DC, but lots of the trustees were in the DB space. So I felt that I could bring a different perspective to that board. And again, I'm not quite a digital native. I think I'm a digital immigrant because when I was at school, we still did things on paper, but my entire working life and university life has been on computers. The trustee board at the time were not like that. It was a very different set of communications expectations. And again, I think that's been a real theme of the stuff I've been involved with. So that's how I got involved. I now am a trustee of the Nautical Archaeology Society, and we're in the process of setting up the International Nautical Archaeology Fund, which will be a charitable incorporated organisation of its own, of which NAS is the main trustee, setting up the investment committee for that. And that's been a really interesting experience, actually going through the governance side and establishing process of a new charity within a charity, and the sort of difficulties of dealing with the Charities Commission, etc. Sometimes you think that other kind of governance organisations might be difficult, but the Charities Commission is quite unique in its speed of response, shall we say. I've enjoyed that. And then also I'm a board director for the Association of Investment Companies, the trade body for investment trusts overall. And that is, again, a very different take on things. So on the pro bono side, I do charities and I've done some pension stuff, and the AIC is a paid role, but it's the corporate world that we're dealing with, and the professional nature of our members on the AIC side is very different to what we see on the charity side. I think just reflecting briefly on charities as well, and I've been involved in a couple of others, the difference in what is expected of a trustee between a small charity and a big charity is wild. So the smaller the charity, the more executive you're forced to be as a non-executive. I built the entire website for one of the charities I was involved with before because they couldn't find anyone else to do it. Not because I'm particularly good at building websites. I did an okay job, I think. Whereas the thoughts of being asked to build a website as a professional trustee or in a large professional organization, you would have someone qualified to do it. Just be aware of what you're getting involved with, I guess is the message behind all of that. But they're always really interesting organizations to be involved with.
I'm sometimes asked by people, when's the right time to take on a non-exec role? And my answer is always now.
Years before you think you want to.
Yeah, because often people make the mistake of thinking, I'll wait till just before I'm ready to retire. But actually, I think there's good data that shows that the highest performing CEOs, one of the common characteristics, they have a non-exec role. I think it makes you better at your job. I think it also is a nice bit of variety in your day-to-day. But I'm curious to hear how your experience of the non-exec world has fed into your executive.
Yeah, firstly, I agree. I think it definitely broadens the mind. And from a non-executive perspective, you have at least to an extent, oversight of everything that an organization does. Although in a larger organization, the charity, by the way, I built the website for was called Marine Life, but in a larger organization, you wouldn't expect to be asked to be building websites. If the organization were completely redoing its kind of digital footprint and redesigning its brand presence, etc., as the board, you would absolutely expect to see that. Whereas in an executive day-to-day role in some organizations, you wouldn't, or you wouldn't be seeing the report and accounts, or you wouldn't be seeing the employee remuneration policy or whatever it might be. So you just get a far broader exposure to everything to do with the business as a non-executive or a trustee in a charity than you would in anything else. So it can't not broaden your horizons. I think you're right that people should do it as soon as they can almost, because I think that sort of eye-opening experience can be very helpful. And also, frankly, because if you want to do it later on as more of a career choice, you're going to need to be able to evidence that you've got some experience doing it. And having just, signed up to something in the last 5 minutes probably won't be enough experience at the time that you really want to. So from the selfish point of view, there's a good reason for getting started early. But I also think it's a great way, beyond just the kind of areas of a business you might not otherwise have seen, it's a great way of getting exposure into entirely different sectors that you wouldn't otherwise. If you are interested in education, for people become governors of their schools, or they become trustees of their local NHS trust, or whatever it might be, those are fascinating and might not be that closely related to your day job. And what other insight are you ever going to get into education or healthcare or these areas that are huge parts of our day-to-day existence? And probably you could add some great value to if you decide that you want to do it. And the other thing is that you get out what you put in. You can be a trustee and be a passenger and not really turn up, or you're going to just turn up to the meetings and not read the papers. And what does the organization that you're a trustee or a director of get from you in those circumstances? But what would you get from doing it? There's no point in doing it unless you commit. And while it can be pretty hard work, I think people do it as well because they actually enjoy it. It can be quite fun taking on these challenges. And otherwise, things can be very kind of samey, can't they? And you never know what new thing is going to come up when you're working in a non-executive capacity for an organization of which you've got oversight, but you aren't in total ultimate control of.
Alex, time has flown by, which means it's time for the lightning round, where I'm going to say a short statement and ask you for a quick response if you're ready.
Okay, all right.
So first up, boardroom behavior that irritates you most.
That's an easy one. It's cybersecurity and paying lip service to it. The number of times that boards sort of say, I want to have a report on cybersecurity, and then they ask you to email it to their Hotmail account. You think, oh my word. So yeah, I think it has to be coming from within that side of things.
Favorite quote and why?
Okay, so this is a cave diving quote, and it's about risk, and it's called Exley's Razor. So apologies, a bit of a long one, but the Exley's Razor says, one never truly knows one's limits until they are encountered. Once a limit is reached and exceeded, return is not always possible. It divides those seeking the knowable from those who have found the ultimate destination. And it's basically summing up this idea that some risks are worth taking, but they still need to be managed because there's certain uncertainties that will arise, things that can happen that you hadn't expected. And if you haven't built in the margin of safety, then frankly, you've just stuffed it up too much and the consequences are absolute. But it doesn't mean that you shouldn't have been trying it to start with.
Your most significant professional insight?
It's nearly always possible to hit an absolute deadline. But if you give yourself 2 extended deadlines, then work will expand to fill the available time.
The worst professional advice you've ever received?
That I would find it boring to take a job in Luxembourg. I should have gone and improved my French and German.
What have you changed your mind on about boards over time?
That they are just jobs for the boys.
What are you invested in and why?
I'm invested almost entirely in investment trusts, and it's because I'm a true kind of believer, I'm afraid. I think that they will outperform over the long term. And although discounts have hurt me recently, I've got some quite good prices on my recent investments because I invest monthly.
Best board interview question.
What did you think of the changes between the last 2 report and accounts?
And finally, 3 things our listeners should take away from this podcast if they take nothing else.
Diversity of thought and experience is vital to all boards. And we all have something to offer to the right board, whether it's a pro bono work with a charity but also you get out what you put in. And lastly, investment trusts are here to stay.
Alex, that has been an absolute pleasure. Thank you so much for sharing your incredible knowledge of the investment trust world. Really enjoyed talking with you.
Thank you. I have greatly enjoyed my time, so much appreciated.
Since recording this podcast, I'm delighted to say Alex Denny has joined Newroll to lead our investment trust team. If you'd like to speak to Alex about your investment trust board or anything else that's come up in this discussion, drop him a line at alex.denny@newroll.com. That's alex.denny@newroll.com.